Hello and welcome to Wall Street Training's module on Finance 101. My name is Hamilton Lin and I have a background in investment banking and mergers and acquisitions, having worked at Goldman Sachs in investment banking, as well as Bank of America Securities in the mergers and acquisitions group, as well as two other boutique investment banks, all focused on mergers and acquisitions. I am a CFA charter holder as well and the president and founder of Wall Street Training. In the next little segment, we will go through an explanation of the basic financial concepts that one must absolutely master, what we call the Finance 101, Introduction to Finance Topics, that one must absolutely know in order to be able to understand the concepts in the basic financial modeling, valuation, how to analyze and rip apart companies. With that in mind, let's turn to our slides at this point. Let's now look at the security market line. The security market line is a graphical interpretation of CAPM. What that means is as follows. The security market line is the same thing as our beta. Let's put real numbers to this now. Let's assume that our risk-free rate is 5%. Let's assume that our beta is 1. That's the market. Let's assume that the return on the market is 15%. So 15% minus 5%, that gets us the market risk premium. What that means is if we were to graphically interpret this CAPM, what we are saying is for a beta of 1, you should return clearly 15%. You should return 15% because that is the market return. Two ways to look at that. If you were to say 5% plus 1 times 15% minus 5%, you get 5% and 10%. That whole thing gets you 15%, which is exactly our return on market here. But now what we're saying is if you had a beta of 0, no correlation to the market, in other words, risk-free rate, that should get you your 5% return. That's your T-bills or your T-bonds. However, if you have a beta of 2, this now means that your required return, your cost of equity, your CAPM return should be 5%. This is a beta of 2 plus 2 times that 10%, which is the market risk premium. That will equal a 25% return somewhere up here, let's say. Therefore, this line is the security market line that now graphs out and says, this is how much you should be valued at. If you deviate from that, we will easily be able to figure out if you're deviating from this and if you're under or overvalued as a stock. So what we're saying is in an efficient market, all stocks and portfolios should plot on the security market line based purely on your level of risk beta. What we're saying is if a stock's return is above the security market line, in other words, up here on top, this is undervalued. You should buy. Why? Because the actual return, folks, think about this. The actual return this stock achieved, let's say the beta here is, I don't know, roughly 1.2. What that means is it actually returned a return up here. However, if markets were efficient, this stock should have returned at this point on the security market line via CAPM. But in fact, it returned higher. Therefore, you should go and buy this. You should grab it quickly. Why? Because the actual return of this stock is greater than what CAPM said it would return. And because of that, that means that this is undervalued. It's cheap because it says it's been priced to return on CAPM, the security market line, but actually gives you a higher return. Hurry up and go buy it. On the flip side, it's also true. If the stock's return is below, then it's overvalued. Why? At a beta of, what is this? Let's say it's 1.9, 1.8. You should have returned this amount on the security market line. However, you actually returned down here. Therefore, you overpaid. The market priced in as if it would return on the security market line up there. But in reality, it returned down here at a significantly lower amount. Therefore, this actual return is less than CAPM. And because it's less than CAPM, this is now overvalued. You should sell. And of course, up here from before, it was undervalued. And as we said before, the expected required rate of return is the cost of equity as well.